The tax-free savings account is built on a simple premise. Money goes in after tax, grows without being taxed, and comes out without being taxed. For most people, that's the entire mental model. A closed loop that works the same way from the day you open it until the day you close it. Except there's a version of that loop that only exists in assumption. The idea that when you die, the account continues to function the same way for whoever receives it. It doesn't. And the gap between what people expect and what actually happens isn't caused by mistakes. It's caused by the way the system is designed. The common assumption. Most people who hold a TFSA believe they've handled the basics. They've contributed within their limit, chosen investments, and at some point filled out a form naming someone to receive it if they die. That form is treated as a formality, a box to check. The assumption is that naming someone solves the problem, that whoever you list will receive the account the same way you held it, tax-free, intact, without complication. This belief isn't irrational. It's based on how most financial products work. You name a beneficiary on a life insurance policy, and they receive the payout. The logic is consistent. And because the TFSA is described as tax-free, people assume that status is permanent, that it's a feature of the account itself, not a feature of the account holder. The confusion is reinforced by the fact that most people never revisit the designation. They fill it out once and assume it's handled. There's no annual reminder, no prompt to review. So the assumption persists. But the system doesn't work the way the assumption suggests. How the system actually works. When you die, the TFSA doesn't vanish, but it does stop functioning as a TFSA in the way you understood it. The account is frozen at the moment of death and valued as of that date. That value is the amount that retains the tax-free status you built. What happens next is determined entirely by how you designated the recipient. And there are 3 distinct pathways. Pathway 1. Successor Holder. If you named your spouse or common law partner as a successor holder, the account doesn't close. It transfers to them as if it had always been theirs. They don't receive a payout. They receive the account itself. The investments remain in place. The tax-free growth continues. This is the only designation that preserves the structure of the account after death. It's also the only one that allows the tax-free status to continue beyond the original holder. But it's only available to spouses and common law partners, and it requires a specific designation. Naming your spouse as a beneficiary does not produce this outcome. Pathway 2. Beneficiary. If you named someone as a beneficiary, they receive the value of the account as of your date of death. That amount is paid out to them tax-free, but the account itself is closed. It doesn't transfer as a TFSA. It becomes a lump sum of cash. If the beneficiary is your spouse, they may have the option to contribute that amount into their own TFSA without it counting against their normal contribution limit, but it's only available within a specific time frame, and only if they complete the required paperwork. If they miss that window, the money becomes a regular contribution. If they don't have the contribution room, they face penalties. If the beneficiary is not your spouse, they simply receive the money. They don't inherit TFSA room. They receive cash, and the tax-free status ends. Pathway 3. Estate. If you didn't name anyone, the TFSA becomes part of your estate. This means it's distributed according to your will, or according to provincial rules if you don't have a will. It may pass through probate. It may be subject to estate administration fees. The value at death is still tax-free, but any growth that occurs after your death, while the estate is being settled, is taxable income to the estate. This is the pathway most people end up on without intending to, not because they chose it, but because they never completed a designation. The tax treatment shift. If the account grows in value after your death, that growth is no longer tax-free unless the account was transferred to a successor holder. So if the TFSA was worth $80,000 when you died, and it grows to $84,000 by the time it's paid out, that $4,000 is taxable income. The original $80,000 remains tax-free, but the shelter ends at death. This isn't a penalty. It's how the system is structured. The TFSA stops being a TFSA the moment you're no longer alive to hold it, unless it's transferred to a successor holder. Why confusion persists? So why don't more people understand this? Part of the answer is institutional. When you open a TFSA, the conversation is about contribution limits and tax-free growth. The focus is on what the account does for you while you're alive. What happens after death is treated as secondary. You're given a beneficiary form, often as part of a stack of paperwork, and asked to fill it out. There's rarely an explanation of what the different designations mean. Financial institutions aren't required to provide estate planning advice. They're required to offer the option to designate a beneficiary, and they do. But the implications are left to the account holder to interpret. And most people don't revisit it. They fill out the form once and assume it's handled. Life changes. Relationships end. New relationships begin. But the beneficiary designation remains static because there's no mechanism that prompts you to update it. There's also a structural misunderstanding about how wills and account designations interact. Many people assume their will controls all their assets, that if they've written a will, everything they own will be distributed according to it. But beneficiary designations override wills. If your TFSA names your sibling as beneficiary and your will says everything goes to your spouse, the TFSA goes to your sibling. This isn't a flaw. It's how the system is designed. But it's not intuitive, and it's rarely explained. Outcome differences. Two people can have identical TFSA balances. Same contribution history, same investments, same account value at death. But the outcome for their families can be entirely different. Scenario 1. Person A named their spouse as successor holder. When they die, the TFSA transfers intact. The spouse continues to hold the account. The tax-free growth continues. There's no payout, no paperwork, no delay. The structure is preserved. Scenario 2. Person B named their spouse as beneficiary, not successor holder. When they die, the account is valued and paid out. The spouse receives the money tax-free, but the account closes. If the spouse wants to put that money into their own TFSA, they need available contribution room. If they don't have it, they either wait or face over-contribution penalties. If they miss the deadline for the exempt contribution, the opportunity is lost entirely. Scenario 3. Person C never named anyone. The TFSA goes to their estate. It may go through probate, it may incur fees, and any growth after death is taxable. The payout is delayed. The tax-free status is partially eroded. Same starting point. 3 different outcomes. Not because anyone made a mistake, but because the system treats each designation differently. What a rational person should verify. This isn't advice, but if you're trying to understand how your own TFSA is structured, here's what you'd want to verify. First, whether you've named anyone at all. If you haven't, the account will go to your estate by default. Second, if you have named someone, whether they're listed as a beneficiary or a successor holder. The distinction matters. If you're married or in a common law relationship and you want the account to transfer intact, successor holder is the designation that produces that outcome. Third, whether the person you named years ago is still the person you'd name today. Circumstances change. Designations don't update automatically. And fourth, that this designation overrides your will. The system allows you to verify and update this information, It just doesn't prompt you to do it. Closing reflection. Financial systems are built on assumptions. We assume that what we set up once will continue to work the way we intended. We assume that tax-free means tax-free, in all contexts, forever. Most of the time, those assumptions hold. But there are edges to every system, places where the rules shift and the outcomes diverge. TFSAs are one of those edges. They work exactly as advertised while you're alive. But the moment you're not, the structure changes and the assumptions stop applying. This isn't a failure of the system. It's just how it's designed. And the people who end up with different outcomes aren't the ones who planned better. They're the ones who happen to check a different box, often without knowing why it mattered. If you found this useful, consider subscribing. Bumble Finance focuses on the parts of the financial system that operate differently than most people expect. No hype, no shortcuts, just structure. Thanks for watching.